Do trading indicators like moving averages, RSI, Bollinger Bands, MACD, etc. really give you an edge in the market, or are they just a fancy way to gamble? We break down how these tools work, their limitations, and whether they can truly help your trading strategy. Imagine staring at a stock chart, trying to predict where it goes next. You see lines, colors, and patterns, all promising to reveal the market's secrets. But do these trading indicators really give you an edge, or are you just playing a sophisticated game of chance? The big debate. This question is at the heart of a huge debate in the trading world. On one side, you have enthusiasts who swear by indicators. They use them to find entry and exit points. On the other, skeptics dismiss them as pure pseudoscience. They argue it's just glorified gambling. So, which side is right? Let's dive in. What are trading indicators? First, what exactly are we talking about? Trading indicators are mathematical calculations. They are based on historical price, volume, or open interest data. These calculations are then plotted as lines or patterns on a chart. Think of things like moving averages, which smooth out price data. Or the Relative Strength Index, known as RSI, which tries to show if an asset is overbought or oversold. The idea is that these patterns can help predict future price movements. The gambling argument. Now, let's look at why some people call it gambling. The market is incredibly complex. Many factors influence price. Past performance is never a guarantee of future results. Critics argue that indicators are simply reactive. They show what has already happened. They don't predict the future with certainty. Relying solely on them can feel like guessing. It's like flipping a coin repeatedly. Sometimes you win, sometimes you lose, but there's no real edge. How they can work. But dismissing indicators entirely might be missing the point. They aren't magic crystal balls. Instead, think of them as tools. They help traders visualize market conditions. For example, a moving average can clearly show a trend. If the price stays above it, the trend might be up. The RSI can signal potential reversal points. It tells you when momentum might be changing. Indicators help confirm your analysis. They can also aid in risk management. They provide objective signals, reducing emotional decisions. They are best used as part of a larger trading strategy. The real verdict. So, do trading indicators really work? The answer is nuanced. They are not a standalone solution. They won't make you rich overnight. But they are far from useless. When used intelligently, they become powerful analytical tools. Combine them with other forms of analysis. Look at fundamental data, economic news, and market sentiment. Understand the bigger picture. Indicators help you make informed decisions. They reduce the element of pure guesswork. They transform trading from pure gambling into a calculated risk. It's about how you use them, not just whether you use them. Call to action. What are your thoughts on trading indicators? Do you use them, or do you think they're just hype? Let us know in the comments below. If you found this video helpful, please hit that like button. Don't forget to subscribe for more insights into the world of finance and investing. Next time, we'll explore the difference between day trading and long-term investing.